Good morning, good afternoon, everyone. Thank you for taking some time to watch our presentation today on why you should consider Roth conversions now. I'm James Bogart, CEO and President of Bogart Wealth. Bogart Wealth is a registered investment advisory firm. We're managing approximately $980 million of client assets. It's about 700 firms. 90% of them are actually ExxonMobil employees. Bogart Wealth is true fiduciaries for their clients, so it means we're legally obligated to put your interest above our own. We have 16 folks on our wealth management and planning team, 4 on our tax team. We've got 3 different offices, one in McLean, Virginia, one in Houston, Texas, and one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. For any of you who haven't been to one of these before, but one of the things I like to say is your kids and your parents can be some of the largest variables of anyone's financial plan. We've made it part of our firm's culture to indoctrinate them in the process, give them access to certified financial planners. We know the impact that we can have at an early age, and a lot of times I like to ask you, what would you do differently now that you know what you know, but back in your 20s or 30s? And one of the calls to action from any of these events that we're doing is to actually sit down and run your numbers. One-on-one financial sessions. They are absolutely no cost, absolutely no obligation. Great way to establish a baseline, see where you're at, especially if we need to be in a position to make some decisions pretty quickly, which I'd say in today's environment, we really do need to do that. A couple administrative things today. I do have the question and answer section open. I also have the chat box open. I will do my best to make sure that I'm answering questions as promptly as possible. Also, we are recording this. It will be on the website after it's recorded. If you'd like a copy of the recording, we're delighted to send that out at any point in time. And then lastly, we are doing a survey at the end. We really do appreciate the feedback. If you could take a moment to fill that out. We do review it, and we're incorporating a lot of those comments into these presentations. And probably a good segue to introduce some of the other ones that we're doing. So this is part of our retirement readiness series that we do. So we have 8 presentations that we've been doing historically for the last several years. In the COVID environment, as we've been doing these more and more virtually, we've been adding in different topics based upon things that people are asking for. Delighted to continue to enhance that as well. But the foundational one that we started doing was our retirement planning timeline presentation. We do one on retirement income planning. We do one on Social Security and Social Security strategies. We do one on tax planning and some tax optimization strategies. We do one on estate planning strategies. We do one on net unrealized appreciation and some post-retirement income strategies, long-term care and long-term care insurance. And then last but certainly not least is Roths versus traditional 401ks and IRAs. And like I said earlier, this list came from the audience. If there's a different topic you'd like to hear us talk about, let us know. Delighted to. At a minimum, we'll add it to an existing one. But if necessary, I'll create a whole new one, which we've done a few times now. And that's probably a good segue to what today's talk is, which again, we're going to talk a little bit about Roth conversions. We're going to set the stage really with understanding the different types of tax deferred and tax-free accounts. We're going to talk a little bit about backdoor Roth IRA strategies, as well as mega backdoor Roth strategies. And then we'll get into some examples of Roth conversion strategies and some things you might want to consider if you're actively employed or if you're now retired, and things that we want to look at. In today's landscape, I do think based upon the outcome of the election that there's a possibility that we're going to see higher tax structure as early as next year. And it might mean ultimately in December that we might want to consider doing some more Roth conversions. And so I'm going to use that to set the stage for essentially what we're going to be talking about today. So to start, the first thing that we want to talk about a little bit is account structure. And so first, we're going to talk about qualified accounts. So this is traditional 401ks, it's IRAs, it's 403bs, it's 457. So first, we talk about the good part. With qualified accounts, you're putting money in on a before tax basis. So it's reducing your taxable income at the highest marginal brackets. It's growing tax deferred. So you're not paying any taxes on gains. You're not paying any taxes on dividends. And traditionally, with qualified 401k plans, you're getting a company match. Now, with ExxonMobil, they've discontinued the match, or excuse me, they've suspended the match effective October 1st. So it's going to be some period of time, I think, before we see that back. But normally, 401k plans are getting a match. Now, there are some negatives associated with 401k plans. The first is if you're under the age of 59 and a half, there's a 10% penalty to pull money out. The second is every dollar you've put in plus the gain off of that money, when you take it out, it's considered ordinary income. And then the third is when you reach the magical age of 72, you have what are called required minimum distributions. I'm going to talk a little bit more detail about that in a minute, but you might hear me use the acronym of RMD. That's what we're referring to here. And what required minimum distributions are is when you turn the age of 72, you're required to start taking money out of your qualified accounts. It's got a very heavy penalty if you miss any amount, as much as 50%, plus you have to pay ordinary income on it. So it can be quite punitive to miss RMDs. Now, in terms of what you can contribute to qualified plans, these are the 2020 limits. I do anticipate in the next couple weeks, we're going to hear what the 2021 ones are. But for 401ks, 403bs, and Roth 401ks, if you're under the age of 50, you can put $19,500 in per year. You also have the ability to do a catch-up contribution. If you're over the age of 50, it's an additional $6,500. Now, the total amount that can go into a defined contribution plan or a qualified plan is $57,000 if you're under the age of 50, $63,500 per year if you're over the age of 50. Now, what this means, let's say that you're over 50, you can put $26,000 in on a before tax basis, or you can put $26,000 into a Roth 401k. It's an either or, and you can do a combination, but you're capped at that $26,000. Now, let's say that your company decides to put an employer match in. I'm going to make the math easy. Let's just say it's $14,000. So the two of them combined are now $40,000. That means that you can actually put an additional $23,500 in on an after-tax basis. Now, for those that are going into 2021, and we're start looking at the fact that ExxonMobil does not have a match next year, or probably won't, you're going to have the $26,000 you put in. I still want it to go in on a before tax basis, but then that's going to give you $37,500 of additional money that can go in tax on an after-tax basis. And I'll talk about why in a few minutes related to some conversion strategies and mega backdoor strategies. All right, related to this is traditional IRA accounts. Same concept here. You're putting money in on a before tax basis, growing tax deferred. Now, with traditional IRA accounts, you have the ability to have what are called deductible as well as non-deductible contributions. And that's going to be dependent upon how much money you earn in a year and if you're participating in a 401k plan or not. So specifically, non-deductible, you can put $6,000 in if you're under the age of 50, additional $1,000 if you're over the age of 50, at any income level. So you can put money into an IRA and not take a deduction, no matter how much money you make. Now, you have the ability to take a deduction, again, same dollar figure, $6,000 if you're under 50, $1,000 if you're over 50. Now, if you're covered by an employer plan, meaning you have the ability to participate in one, if you're single, if you make over 65,000 up to 75,000, you start getting phased out. And once you make over 75,000, you have no ability to take a deduction. If you're married, starts at 104,000 up to 124,000. So if you're married and make over 124,000, there's no ability to take a deduction. Now, if one spouse is covered by a plan, the deduction threshold rises. It starts to phase out at 196,000, 206,000. It's completely phased out and no longer eligible to take a deduction. So that's IRA accounts. Now, we want to compare that to Roth accounts. So this is specifically Roth 401ks as well as Roth IRAs. Now, this is where money goes in on an after-tax basis. So if so you're putting it in after you've earned it, after you've paid taxes. However, the growth is now tax-free, and the withdrawals of principal are always tax-free. Withdrawals of growth are tax-free as long as you're over the age of 59 and a half and it's been in existence for over 5 years. Prior to that, you have the ability to take it, you can take it out, but you have to pay a 10% penalty. Now, Roth IRAs are not subject to required minimum distributions. However, Roth 401ks are. So typically, if you've put money into the Roth 401k, it's been accumulating there. More often than not, by the time someone attains the age of 72, we want to get the savings plans out of Voya because we don't want to have to take RMDs on the Roth 401k portion. Obviously, Roths are a great way as well if you're in the fortunate position that you're going to be leaving some money to the next generation. Provides them some tax deferred growth as well, or excuse me, tax-free growth as well. I had a couple questions come in. Deductions on the previous page. Are we talking 1040? Yes. So this is if you want to put 7,000 in and be able to take a deduction off of it. And then the question was, does a SEP, I believe you said SEP 401k, I believe you mean SEP IRA, is that counted as covered by a plan? Yes, it is as well. So this is any level of retirement account, even if you're self-employed and have the ability to do a SEP. Now, candidly, if you have the ability to do a SEP, contribution levels are what they were at the previous page, so significantly higher. All right. Couple things with Roths. Now, with Roths, Roth IRAs, same contribution limits. So you can put $6,000 in if you're under the age of 50, $1,000 in if you're over the age of 50. Now, the phase out limits in terms of the ability to do a Roth contribution change based upon if you're single or married. So if you're single, if you earn under $124,000, you can do a direct contribution. It starts to phase out. And if you make over $139,000, no longer eligible to do a Roth contribution at all. For married households, starts to phase out at 196,000. At 206 and above, no longer eligible to do Roth contributions. Now, the second way that you can get money over into, this is just talking about Roth IRAs. Roth 401ks, you can do the contribution no matter what your income level is. However, you're going to be giving up the ability to do before tax contributions. Important to note that. Now, Roth conversions can be done no matter what your income level is. Really, the restriction is going to be on your desire to have the tax pain, if you will. So what a Roth conversion is where you actually take some of that pre-tax money, whether it's a 401k or traditional IRA, and you convert it over to a Roth IRA. In order to do so, you pay ordinary income on the amount you convert in order to then have it in an environment where it's now growing tax-free forever. So and I'm going to get into some strategies here in a minute, but I'm just trying to give a high-level education point here. So when it comes to the basics of Roth conversions, a conversion is a penalty-free taxable transfer of amounts from a traditional IRA to a Roth IRA. You can convert part of or all of the money in a regular IRA over to a Roth, so you're not restricted on doing the entire account. When you convert your traditional IRA to a Roth IRA, you're going to pay income tax on the taxable amount. Now, this is a strategy that's now been in existence for about 10 years. Prior to 2010, there was an income threshold cap on conversions. It was $100,000 of income. So a lot of people weren't even able to actually do Roth conversions because their income was above the threshold. That went away. And that's actually opened up some different planning possibilities. All right, question came in. Can I put post-tax 401k into a Roth? So can you put after-tax 401k into a Roth? Yes, hold that thought. I've got some stuff coming up on strategies within the 401ks here in a second. All right, couple things. Let's talk about why someone would want to convert, and we'll talk about why they wouldn't, and let's also talk about prioritization of savings and where we think they should be. So again, we can do contributions at any age as long as you have earned income. With Roth, the benefits are that the distributions are income tax free. And again, very big one is there are no required minimum distributions during the Roth IRA owner's life. Again, Roth 401k has RMDs. And if it becomes an inherited, those will have RMDs as well. And I'll talk about that also in a second. But we're really going to be doing this because we're looking for tax diversification. We're also looking for tax-free growth. If we anticipate your income to be higher the later years, then we might want to consider doing more now. If we anticipate tax rates to be higher in later years, we want to do more Roth IRA. And also, if you're in a position where you're going to be leaving money to the next generation, kids or other heirs, non-charity, we want to consider doing Roth IRA as well. So kind of summarizing this in an easier chart, but if income tax rates are going to be higher in the future, we should consider doing Roth IRAs or doing Roth conversions. I do think that depending upon the outcome of the election, there's a high probability that we're going to see a higher tax structure. That means we might want to consider doing more Roth conversions in 2020 if that's possible for you. If you expect your income and spending to go up significantly faster than inflation between now and the end of your retirement plan, also, if you anticipate income tax rates all to go up in the future, which again, same concept here. Also, if you're in the position where required minimum distributions are going to create an issue for you, I've got some examples of this coming up, but what this means is that the amount that you're bringing in from Social Security income plus the required amount you have to take out of your retirement plans is higher than you want to spend. That creates some inefficiencies. That means that you're going to have additional taxable income that could potentially push you into higher tax brackets. It's a great problem to have. My point more is let's look at strategies to mitigate that going into the future. Also, if you're, like I said before, if you're in a situation where you're going to be leaving a legacy to family members, Roths are great. Now, that said, while you're working, one of the best places to save is on a before tax basis. And the real reason for that is because the progressive nature of our tax brackets favor pre-tax contributions over when you take the money out. So remember, when you take the money out, you pay an effective tax rate. It's an average. So for example, there's the tax table for 2020. And we do know that the 2021 just got announced yesterday. These thresholds are a little bit higher, but the percentages under current legislation have not changed. So we know that the marginal tax rates go from 10% to 12 to 22 to 24 to 32 to 35 to 37. Now, let's just say that you are married filing jointly. You're right at the top end of the 22% bracket. Which means your income is coming in at $171,050. You're in the high end of the marginal tax bracket. However, your effective tax rate is 17.1. And that's because the first 19,750 was at 10%. Then the delta underneath 80,250 was at 12%, et cetera, et cetera, et cetera. Your effective tax rates under a progressive tax structure are always going to be lower than your marginal tax rates. And so as you're saving, and if you're doing it on a before tax basis, the 401k contributions, traditional 401k contributions, are reducing your taxable income at the highest marginal brackets. So again, if you're in the 22% bracket, all of that savings is happening at the 22% threshold. It's not blended over the average. So we are still very inclined, and again, everyone's situation is going to be a little bit different, but very inclined to recommend the first dollars that we're saving happen on the pre-tax side, not the Roth, especially for an employee who's at the later stages of their career, probably at the highest marginal tax brackets that they've ever been at. So here's a quick example. So assume married, each spouse has $80,000 a year of income, $160,000 combined. Their marginal tax rate's 22%. So let's say they've got $20,000 to fund to a 401k. Now, if they do a traditional 401k, their taxable income is going to drop from 160 down to 140. With the Roth, if they put the money in on an after-tax basis, they're going to have to pay the tax rate on the front, which again, marginal bracket. So now they're only going to be putting in $15,600. So let's talk about what this looks like if you can continue to save and it continues to grow. And so let's just use a hypothetical 30 years at using 8% returns. Now, the traditional balance would accumulate up to $2,265,664. The Roth would accumulate up to $1,767,218. So remember, with traditional, we're saving at the highest marginal, whereas with Roth, it's going in after taxes. So let's continue to play this example out a little bit. So again, after 30 years at 8%, you've got the 2.26 million. With the Roth, we've got 1.76 million. Now, let's assume that we need to go ahead and turn this into cash flow. We're going to start withdrawing. So let's just say at 6%. Again, these are all hypotheticals, but at a 6% withdrawal rate, the traditional, you'd be able to take $164,598. With a Roth, you'd be able to take $128,386. Now, obviously, with the traditional, we're going to have to pay ordinary income. Roth, we won't. So if you have a tax rate of 22%, then you'll notice on an after-tax basis, you're going to be pulling out $128,386 versus with the Roth, $128,386. So the point is, if your tax rates are the same, there's no difference between Roth versus traditional. However, to the point I just made 2 slides ago, they're not. Even if you're in the 22% marginal tax rate in retirement, your effective tax rate, what you're going to be pulling out, is actually going to be lower than 22%. So that still is favoring putting money in initially on a before tax basis. All right, couple other things to talk about with conversions here. Let's say if you live long enough, you're either going to have one or two possible scenarios. You're going to deplete your IRA, or you're going to have required minimum distributions that are greater than your living expenses. We call them surplus RMDs. So when we have this whole discussion around convert or not, we're going to want to look at your tax bracket. Now, do you think that you're going to be in the same or higher bracket when you retire? If the answer is no, then converting to a Roth might not make sense. But if the answer is yes, then we need to start evaluating the time horizon. Do we expect to start making withdrawals in 5 years or more? If the answer is no, then it's not sufficiently long enough to really look at the tax accumulation or savings. But if the answer is yes, then we need to factor in the impact the taxes are going to have and at what threshold makes sense to do this or not. All right, had a couple questions come in. Should we use 6% as a withdrawal rate? I heard to be conservative, we should use 3 to 5. Yeah, sorry, this was an illustration only to just show the point that if you were pulling out at 6%, that's the differential of the two based on the previous account balances. So this is just 6% of the 2.26 million or 6% of the 128 million. To answer your question on successful and viable withdrawal rates, so typically a 5% withdrawal rate off of a portfolio will have a longevity of 41 years. A 3% withdrawal rate will have a longevity of 99 years. So dependent upon someone's situation, and again, your overall need and draw, we absolutely should be monitoring a withdrawal rate, because that's one of our leading indicators in terms of success and longevity of anyone's retirement portfolio. All right, so someone asked a question, how do you determine how much of one's portfolio should be in a Roth if you expect taxes to increase? That's a great question, actually. So in terms of determining how much should be in a Roth versus how much should be in pre-tax, and specifically if we need to be doing conversions, we really need to be doing projections long-term on someone's portfolio and really understanding the implications of those required minimum distributions. So going back to this slide here, if you're in the situation where you're going to be spending down retirement accounts, it doesn't really necessarily make a whole lot of sense to be effectively really jacking up your tax rates in early years if ultimately RMDs aren't going to have any level of implications and your effective tax rate's not moving up. But if you're in the situation where based on what you're spending and your portfolio's growth and accumulation, if the growth and accumulation are all of a sudden accumulating faster than what you're going to be needing to take out for your needs, and there's what we call excess, well, then definitely want to be looking at doing conversions. Now, the way that Bogart Wealth actually goes to execute these strategies, every year we're building out tax performance. We're looking at what a client's tax situation is to then be able to determine the specific amount. In a second here, I'm going to show an example of what an illustration of Roth conversion benefits looks like. But when it comes to actual execution, we're still going to want to build out that actual pro forma, see what's specifically happening this year, and then also incorporate it with someone's plan to then determine the sequencing and timing of when it may or may not make sense. Let's see, someone asked the question, can ExxonMobil shares be converted to a Roth IRA in kind, or do they need to be sold first and cash should be converted? All right, great question. So ExxonMobil shares, if they're in a 401k, in order to be converted, they need to be sold and then bought back. If they're in an IRA account, we can convert shares as shares. That's another benefit potentially of considering rolling the savings plan out of Voya to then have the ability to convert shares as shares if we don't want to deal with the timing mechanism there. All right. You said you may want to do a conversion in 2020 if the next administration raises the tax rates. Couldn't we still do it in early 2021 before any tax law changes, or can the next administration make tax hikes retroactive? So we have precedents where there have been administrations who have been able to make tax adjustments retroactively. not just on a go forward basis. Again, I'm not making any level of decision on strategy right now until we have a higher probability of outcome. But this is one where why we're doing this presentation is because it's something that we want to make sure is on everybody's radar and something they should be considering from a strategy perspective. All right. So here's a quick illustration of a client case that was talking about the benefit of doing Roth conversions. So in the particular client's case, they were in a high tax bracket the year of retirement. And then because they've got other assets to be able to live off of, their tax rate drops dramatically down to the 10% bracket. All they have is dividend income coming in. And then all of a sudden, we start pulling on retirement accounts, and then they hit the age of 72, and boom, they jump right back up into the 33% tax bracket. And so in the base case version, this is an illustration, but it is someone's plan. They were projected to leave a very beneficial amount of almost 12.8 million to their children. Now, almost none of that was in Roth tax-free assets, about 170,000 of it. Almost 8 million of that was going to be in the tax-deferred assets. That's specifically IRAs and 401k plans. By the way, this is obviously a larger number. Everyone's numbers are going to be different, but it doesn't have to be this big for there still to be benefit. Now, what we did here for this client was we illustrated just some basic, what we call bracket bumping, where we looked at their situation and we made the decision to convert up to certain marginal thresholds and really trying to enhance the optimization. So now what it did for this particular client was we converted about 700 grand over a 4-year period of time. And now we took the 170,000 of tax-free assets and it's now up to 3.2 million. It also enhanced the long-term amount that's transitioning up to 13.1 million. Now, to do this, that means that you're effectively paying some taxes now in order to reduce the impact of your RMDs over your lifetime, but it's also going to transition the way that the wealth is transferred to the next generation. So one thing that happened at the end of 2019 was the Secure Act passed. What the Secure Act did was it changed the RMD age from 70 and a half up to 72. That was the good part. The real bad part, though, was they changed the ways that your children can inherit retirement accounts from you. They used to be able to inherit it and stretch out taking RMDs over their lifetime. However, now, if they inherit retirement accounts, they've got to take out the entire balance of the retirement account over a 10-year period of time. So in this particular client's case, their kid's going to inherit $8 million. Well, or excuse me, 12.8 million, but 8 of that 12 is in a retirement account, specifically an IRA account. Now, in that example, in a 10-year period of time, let's just say it's one child. Well, that means they got to pull out 800 grand a year at a minimum in order to be able to satisfy the RMD requirements. Or if they just wait, next thing you know, they're taking out all 8 million in several years. They can do that, but it's a huge tax bill, high tax rates. Whereas what we're doing here is we're able to transition wealth, so more of it's going to the children tax-free. Now, inherited Roths, still have required minimum distributions, but it's going to be, in this case, 3.2 million that's going to them tax-free. So a lot of people say, hey, you know what, kids getting a lot of money, I don't really care. Well, let's talk about why it matters to you. So in the base case, we projected this particular household's required minimum distributions to be 11.8 million. With doing just 700,000 of conversions, we dropped the RMDs to 10.1. So it had an effective reduction of their RMDs by $1.688 million. Now, okay, all well and good. What we really care about is what it translates to in terms of tax savings. So in the base case, we were projecting that they were going to pay 4.99 million in taxes. We were able to drop that down to 4.47. So it was a $518,000 tax savings. Now, this is just one series of optimizations. Theoretically, we could do more. And in a case where we all of a sudden are going to be in a situation where we're going to see significantly higher tax brackets, then we might want to actually consider doing higher marginal thresholds than even this illustration shows. And so the impact on taxes is essentially that, right? Where we go from having low effective tax rates in the base case if we do no optimization, to then deciding to enhance a little bit and bring them up to smooth out the curve for the rest of your lifetime. That's why you care. But if it has a double benefit of also transitioning more wealth to the kids, which is going to go to them tax-free, that does make a lot of sense as well, something that we should be considering. All right, so some of these conversations, a lot of people say, well, why don't I just save in the Roth 401k? Well, I'm going to come back to you and say, again, because of the progressive nature of our tax brackets, we still need to factor in what the impact of giving up the pre-tax contributions are, what versus what your effective tax rates are. And so what we need to look at is what your marginal rate is versus your average tax rate. And there's obviously a clear delineation in terms of the benefit of where it's going to be more advantageous to save for the Roth versus saving in the pre-tax. And again, as long as your effective tax rate is lower than your marginal tax rate, it's going to favor saving initially and not giving up any of that pre-tax exposure. I had another question come in. I want to make sure I get that. Is there a waiting period between when you can draw on funds which have been converted from a traditional to a Roth IRA? Great question. So the answer is, on your principal, no, there's not a waiting period. On the appreciation, yes. So in order for the gain to be tax-free, you have to be over the age of 59 and a half, and it has to be in existence for 5 years. So for some clients, we're just saying, hey, let's get a Roth open so we can start that 5-year clock, because it's not based on new contributions that go in. It's based on the inception when that account started. Good question. All right, couple strategies to talk about related to, a question came in. Is the effective tax rate the same as your average tax rate? Yes, it is. Effective tax rate is what you're actually paying, which is also what the average is based upon your taxable income. All right, couple other things to talk about in terms of strategies to consider. So if you remember, I mentioned that you have the ability to put money into a traditional IRA and not take a deductions, assuming that you're over a higher threshold. So what this does is this introduces this concept called the backdoor Roth contribution. And so really what it is if you're above a certain income threshold, you have the ability to put money into an IRA account and not take a deduction off of it. Now, by the way, real quick caveat, this strategy only works if you do not have IRA accounts. So it really is designed for those that are working, and maybe you're putting everything into your 401k plan, but you don't have IRA accounts outside of your 401k plan. But what the backdoor Roth is because you don't have an IRA, we can put money in on an after-tax basis into an IRA account and immediately convert it to a Roth. Because again, there's no income thresholds on conversions, and there's no income thresholds on putting an after-tax non-deductible contribution to an IRA in. It's one of those strategies where if you're in the position now, the kids have graduated off the payroll, got some discretionary cash. Well, if you don't have an IRA, boom, this is the first place that I love to see savings happen. Or let's just say one of your children is doing really well and starting to accelerate and they get above those income thresholds. They don't have an IRA, boom, same thing for them. Another question came in. Does a Roth IRA and Roth 401k both have the 5-year clock requirement? So the gain, yes, will still have to be 5 years of inception. The principal is always able to come out tax-free. Good question. All right, so from one of the planning strategies that we're real keen on, especially while you're still working and still accumulating, absolutely, we want to make sure if we've got discretionary cash, backdoor Roth's a great strategy to look at. Now, this also introduces another strategy that's become very popular, especially since ExxonMobil's suspended the 401k match, which is this whole concept of mega backdoor Roth strategy. I have a whole Zoom presentation that's just on the mega, but what this is instead of using an IRA as the conduit, we're actually going to use the 401k. You have the ability to put money in, as I mentioned earlier, into the traditional 401k on an after-tax basis. And so since there's no company match coming in and dependent upon your income threshold and ability to save, you can put all the way up to $63,500 into the 401k. Again, I'm going to want to see 26,000 of that be before tax, but the rest of it should go in on an after-tax basis. And then you have the ability to go ahead and convert it over to a Roth. It's fantastic. It's a great way of leveraging the ability to save. And even within the plan, you are still restricted at the 20% per month of your pay contributions that goes into the plan. So we need to help with the math. We've got some great illustrative tools on that. But this is also something that we want to talk about in terms of, if you have the ability to just do even some catch up at the end of the year, boom, another great way of doing this strategy. And I'm going to talk about execution of this here in a quick second. Does the 5-year clock on Roth earnings start with your first dollar Roth investment? Yes. So it's based on the inception value of the account when it was first went in, not based on when we did a conversion or if you did a contribution. Yeah. All right. Now, a couple things related to the savings plan. One of the strategies that we talk about, and I just introduced it, this whole concept of mega, but is actually where you have the ability to convert your tax paid credit balance within the savings plan over into a Roth. So it's called a tax paid withdrawal. Now we're specifically talking about this category that's called the pre-87, post-86 contributions. This particular individual had done a lot of after-tax contributions over their career. They had accumulated about 274,000 of after-tax dollars that had gone into the 401k plan. Now, this is very different than their after-tax amount. Their after-tax is including all of the gain. So while this tax paid credit balance is sitting in the savings plan, the gain is happening on a pre-tax basis. And so one of the strategies is get it out of the environment where it's growing tax deferred or pre-tax, get it into an environment. So take it out and get it into a Roth where it's growing tax free. So in order to do this, you actually have to take the tax paid out, you have that go to a Roth, and then you take out all of the appreciation off that money and have that go into a traditional IRA. At ExxonMobil, you have the ability to do this twice a year. It's called a tax paid withdrawal. You call into benefits, they'll help you with the math of what's eligible to be able to do this. So there is a little bit of a restriction associated with what's eligible to come out. However, it's a great strategy to look at. This is something that we're helping with our clients. I'm happy to be on that call, or any of my staff members are happy to be on that call and help with the math and help with the execution here. I had another question come in. So if I have income over 200,000, can I do a mega Roth conversion? Absolutely. That's the whole point. These mega backdoor conversions are more impactful for anyone who's actually in a higher income scenario, because even with this backdoor strategy, the backdoor, you can put $7,000 in if you're over the age of 50. But if you're at a higher income level and you have the ability to save, as I mentioned, especially because ExxonMobil discontinued the match, you have the ability to put 37,500 in on an after-tax basis and flip it over to the Roth. So it's almost 5 times the amount that you would be able to save just in the backdoor all on its own. So definitely something to be considerate of. All right. So frequency allowed for the mega backdoor in 401k is twice a year. So the answer is frequency to do the tax paid withdrawals. Actually, have that coming up next slide here. But tax paid withdrawals can be done twice a year. A conversion can be done once a year. All right. So by the way, the strategy that I was just talking about here has to do with tax paid withdrawals. You also have the ability to do conversions within the plan. So a withdrawal is very, very different than in-plan conversions. In-plan conversions can actually have unexpected tax consequences. So something, let's help with the math on this. So employees that are 59 and a half and younger can convert a portion or all of the balance of their after-tax and general accounts to a Roth, but they cannot convert any of the before tax over to a Roth. Anyone who's over 59 and a half can convert all of the balances of non-Roth accounts over to the Roth conversion account. Now, one thing that we get asked a lot is converting stock. That was a question we had earlier. And think about it. The basis of your Exxon stock within the plan, yes, ExxonMobil is great. They keep the history of all of it. But for conversion purposes, a lot of people say, why don't I convert the higher cost basis stock over the Roth? Well, for conversion purposes, remember, we're paying ordinary income on the conversion. So for all intents and purposes, the basis of your stock is zero. They don't care. It's ordinary income based on the gross amount that gets converted. Now, the whole reason you would convert stock, which is down, over to a Roth is if you assume that the appreciation is going to happen at a later date. But be mindful of that, because ultimately, when we go to convert shares, there's actually, as I mentioned earlier, you have to liquidate the shares and then do the conversion as cash. Again, this is within the savings plan. And then once it's over into the Roth account, then you can buy the stock back. There's about a 5-day window on that conversion that, as we've seen how quickly the ExxonMobil stock's moving recently, that could be very, very detrimental to someone's timing of this. Now, when we're doing in-plan conversions, we got to be very careful if there's gain on that tax paid credit balance. So you might have, as I mentioned in this example earlier, 274,000 of tax paid balance, but it's worth 570. Well, it's got a lot of gain there. And so if the entire account is after tax, and let's say 60% of it is after tax contributions with 40% of untaxed appreciation, well, if we convert that entire amount over, then 40% of that's going to be considered taxable income. If we convert 50% of it, then 40% of the 50% is taxable income. If we only did 10%, then 40% of the 10% is going to be considered taxable. There's a prorated calculation that happens there. That's ultimately why I'm a big advocate. Let's take the tax paid out. Let's get it to a Roth, take the gain out as well, have that go to a traditional. And then at that point, the Roth bucket is all growing tax-free from that point forward. One thing to make sure that we're considering in relation to all of these strategies is if you still have ExxonMobil stock in the savings plan, let's make sure we're still factoring net unrealized appreciation, that's your low basis stock, into the overall math for the considerations of whatever we're looking at doing here. Okay, I've covered a lot today, and I know there's been a lot of questions. In terms of some things that we should be looking at now, in this environment with all of the uncertainty, especially if you're still actively employed, you got to be in a position to make decisions quickly. I do think that something's going to be coming announcement wise from the company in the next day or so. Need to be in a position to be able to make decisions very, very quickly. Have a plan, understand your budget, understand future cash flow needs, understand your risk profile. I also think that it's really important that if you're still going to continue to work, increase savings in retirement accounts when the market's down. That's the number one way of accelerating as things get back on track. We saw that in March. By the way, this was a point that I made in March, was get all of this stuff done, get conversions done while the assets are down, get more saved while the accounts are down. Past that, let's look at some tax loss harvesting. I mean, frankly, ExxonMobil stock this year is down. If you've got after-tax shares, restricted stock grants, et cetera, let's look at that. Now, by the way, real quick caveat to that. If you are still receiving restricted stock grants, do not sell any positions at a loss right now until the next wave of grants are vested. We're now in that window of time where the grants are going to be vesting. And typically, if you buy stock within a 31-day period of time, it's called what's called a wash sale rule. If you buy stock, it will negate whatever we sold positions at for a loss. And restricted share grants, because those are considered purchases of stock, want to make sure you're not selling any stock at losses right now. Wait until after those restricted share grants come in December. Also, consider doing those conversions of the tax paid over, what we were talking about here. Let us help you with the numbers on that. Also, right now, interest rates are still very, very low. Let's look at refinances. And if you haven't heard from your advisor in a very volatile period of time in the market with everything going on with ExxonMobil, really need to understand if that's the right advisor for you. So again, one of the calls to action from today's presentation is let's have a one-on-one conversation. Let's put yourself in a position to be able to make decisions very, very quickly. This is our contact information. I know Mindy and Sydney are going to be reaching out today and tomorrow, to follow up off the presentation. Again, we did record this. Happy to provide the slides. The recording will be on the website. We'll also be able to send the link out in a few hours from now. And also, please, please, please do the survey at the end of this. Really, really do love to get the feedback. I'm delighted to be in a position to add value, add more content. All right. Thank you very much. You have a great day.